Welcome to the Explainer. Today, we are pulling back the curtain on the super complex world of options pricing. We're going to uncover the 5 hidden forces, what traders call the Greeks, that really control why your options move the way they do. Has this ever happened to you? You watch a stock's price go up and up, but your call option, it barely budges. It is a super common and, let's be honest, frustrating puzzle. The thing is, an options price isn't just about the stock's direction. There are these powerful forces working behind the scenes. So, the secret to finally understanding all this behavior comes down to 5 hidden forces. And together, they're known as the options Greeks. Each one is named after a Greek letter, and really getting a handle on them is the key to making smarter, much more informed trades. Okay, first up, let's talk about the price movers. That's delta and gamma. These are the 2 Greeks that are most directly plugged into the price shifts of the underlying stock. So let's start with delta. The best way to think about it is like your options speedometer. It tells you exactly how much your options price is expected to change for every single 1-point move in the stock. It's really the most fundamental Greek you need to know. Now, here's where it gets really interesting. Delta acts differently for calls and puts. For a call option, delta is always going to be positive, somewhere between 0 and 1, because a call's value goes up when the stock price goes up. But for a put option, delta is negative, from 0 down to -1, since its value goes up when the stock price falls. Make sense? All right, let's make this concrete with a quick example. Just imagine the Nifty index is trading at 9150, and you're looking at a call option that has a delta of 0.5. Pretty standard setup. And then the market moves. The Nifty jumps up 30 points to 9180. So based on what we know about its delta, how should our options price react? Well, the math is actually really simple. You just take that delta of 0.5 and you multiply it by the 30-point move. And what do you get? Our call options price is expected to go up by 15 points. See? This shows you perfectly how delta translates a stock's move directly into an options price change. But wait, delta has a pretty cool second job. It works as a rough probability gauge. So a delta of 0.5 also suggests there's about a 50-50 shot that the option will expire in the money, which just means it'll have some real value at expiration. Now, it's not a crystal ball, but it's a super powerful quick check for any trader. But here's the catch. Delta isn't a fixed number. It actually changes as the stock price moves around, and the Greek that measures this change is gamma. So if delta is the speedometer, you can think of gamma as the accelerator pedal, telling you how fast your delta is changing. Now, if you're just starting out, you really don't need to get too bogged down by gamma. But just keep this in the back of your mind. A higher gamma means your delta is going to change way more dramatically with stock price moves. It's kind of like the win more or lose more factor. It juices up both your potential rewards and your risks. All right, let's move on to our next pair, theta and vega. I like to call these the invisible forces because they're not really tied to the stock's price, but more to things like time and overall market feeling. First up is theta, and the best way to picture it is like a melting ice cube. Theta measures time decay. It's the amount of value an option loses every single day that goes by. It is the unavoidable price you pay for holding an option over time. And this is a classic 2 sides of the same coin situation where your strategy really matters. If you're an option buyer, theta is your enemy. That daily decay is constantly chipping away at your position. But if you're an option seller, theta is your absolute best friend. You're actually profiting from that daily time decay. Okay, next up is vega. This Greek isn't about price or time, it's all about volatility. You can think of it as the market's fear gauge. Vega tells you how much an options price will change for every 1% change in implied volatility. So when things get uncertain and fear spikes, options get more expensive, and vega is what measures that sensitivity. So what is volatility, really? Well, it's basically a measure of uncertainty. The more the market is unsure about a stock's future, the higher its volatility. And that usually means higher option prices because there's a greater chance of a big, wild price sweat. Now, it's super important to know the 2 flavors of volatility. You have historical volatility, which is backward-looking. It tells you how much a stock has moved in the past. But then you have implied volatility, or IV, and this is forward-looking. It represents the market's best guess of future moves, and this is the one that vega is directly connected to. Okay, we've got one last Greek to cover. It's often called the forgotten Greek, but hey, it's still part of the family. So let's talk about Rho. What Rho does is measure how sensitive an options price is to a change in interest rates. We're talking about the risk-free interest rate, like what you'd get from a T-bill. If that rate were to move, it would have an impact on option prices, and Rho tells us by how much. So, why is it the forgotten one? Well, for the short-term options that most traders are dealing with, the impact of interest rate changes is usually teeny tiny. Rates just don't move fast enough to really matter over a few weeks or months, so most traders, frankly, don't pay much attention to it. All right, so we've got all the pieces of the puzzle. We've met delta, gamma, theta, vega, and even rho. Now let's see how this all comes together in a tool that traders use every single day. And this is the engine room. What you're looking at is a Black-Scholes calculator. It's the standard, widely accepted formula that takes all these concepts and uses them to figure out the theoretical price of an option, and most importantly, all 5 of the Greeks we just talked about. So how does it work? It's pretty simple, actually. You just feed it 6 key bits of info: the current stock price, the option's strike price, how many days are left until it expires, the implied volatility, the interest rate, and any dividends. You plug those in, and bam, it spits out a full profile of your option's risks and characteristics. You see, at the end of the day, understanding the Greeks completely changes the game. You go from being a passenger to being the pilot in your own trades. You're not just reacting to price changes anymore. You're actually anticipating how time and volatility and all these other market shifts are going to affect your position. You've decoded the hidden language. So the real question is, now that you speak Greek, what are your options going to start telling you?